Hello and welcome to the weekly Founding Fathers webinar. I'm Craig Yenny and I'll be standing in as your host for this episode. Although Jason Sipple is not able to join us today, we're both excited to bring this webinar to you in another teaching in how to take control of your money. And I also look at it as building a war chest for your family. So in today's episode, we're going to be covering how to pay down third-party debts using the infinite banking concept process. Now, before we get started, if you're watching this on YouTube, go ahead and smash that subscribe button. It's really important for content creators. Jason loves to see the comments. He loves to have more subscribers. So if you haven't already subscribed, we'd appreciate that if you go ahead and hit that subscribe button. So with that said, I'm going to go ahead and share out my screen and we'll get started with the presentation for today. All right, today's session is going to be about how to pay down third-party debts using the infinite banking concept process. And what we're going to walk through, just to kind of give you a quick preview, we're going to talk a little bit about the debt situation that's not only happening in America, but within families, and how does that correlate to some of the savings and where our money's going. And then we'll get into the actual process of how we use infinite banking to pay down those third-party debts. So just curious in the audience here, anybody have third-party debts, whether that's credit card, car loans, personal loans, anything to pay down that you are currently have on your debt profile? So we got a few people. All right. So I'm going to go over a little blurb I found on the Federal Reserve Bank of New York, and it just kind of paints the picture of what the debt situation looks like in the US today. So we currently have a rising debt. So this was kind of a marker put in place in the second quarter of 2023, where we started seeing household credit card debt and third-party debts on the rise. And it just blows me away to see that we're at 17.06 trillion. So that's the credit card balances, and kind of showing that it's on an uptick trend where, back in the report in quarterly, the quarter of 2023, we saw it rise from 45 billion to over 1 trillion, and then it just kept on going. So this kind of paints a bit of a grim picture for how people are treating credit cards, how debt's getting accumulated. And there's a lot of favorable, cards out there, 0%. I think people get on the hook and then, hit those points where the credit cards increase. Now you went from a 0% to a 25, 29, 30%. So what I like to do is I like to look at that in correlation to kind of where's our savings as a country. And if you look at this chart, it goes all the way back to June of 2015, we're somewhere in that 5, 6, 7, 8, 9 range, and it's pretty steady. And then it's interesting to see what happened during COVID. We didn't have anywhere to go. We couldn't go shopping. There's nowhere to spend money. So what did people do? Well, they saved it. And so we saw the savings rate spike way up during COVID. And then after things opened back up, we got to go out, we're traveling again, we're on airplanes, we're in restaurants, we're shopping. And consequently, the savings rate followed a downward trend. And now we're kind of hovering below that 5% mark. So when you start looking at the credit situation on a significant rise, along with a lowered savings rate, it's a dismal condition for the country to be. But for the folks watching this and being participants of infinite banking and all of teachings that we have, hopefully you're doing things differently. One of the things I want to go over is when you have a dollar, where is it going? And generally speaking, about 20 cents of every dollar goes for automobile expenses. That's the loans, repairs, your gas. You've got about 30 cents of every dollar going to housing needs, and then 40 cents of every dollar going to everything else. So this is your dining out, your clothes, your recreation. And then far on the right, we have our 10 cents of savings. So one of the 6 laws of wealth that Chris Nagel talks a lot, he's always saying at least save 10% of everything you make. The 10 cents that's in this bucket, what do we do with that 10 cents? Well, it's either sitting in a savings account doing almost nothing, or we've taken that savings and turned it into hopefully things like investing, and most times that's going into high risk types of investments. And I don't know if you're like me, but when I was meeting with financial advisors years ago, just trying to figure this whole money thing out, one of the common questions they would always ask me is, what's your risk tolerance? How much are you willing to lose? Maybe I felt like I was kind of an odd creature, because to me, I don't want to lose anything. It's really hard to earn money. I don't want to lose anything. So we're taking that 10 cents and we're putting it at high risk. But what if we were able to do something with that savings that would help us also capture interest that we're paying for automobiles, or interest we're paying for credit cards and personal loans and medical bills? That's what today's session is all about. So we're going to be going through a use case. We have a tool here in our community we call Debt Blaster. And the whole concept is it's a tool paired with infinite banking concept process to show you how you can take your third-party debts, whether it's credit cards, personal loans, medical, student loans. It doesn't matter the type of debt, but we're going to show you how, instead of paying Visa or paying American Express, how can you just simply change one thing and write that check to the bank of you? So that's what we're going to go through today. Please feel free to answer questions as we go through this. It's probably going to be easier if you just put those in the Q&A. I'll be keeping an eye on that as we go through the process here. So to get started, we talk with a lot of clients. We help a lot of people through the infinite banking process. So what I'm going to be showing you today is not a specific client. I've actually changed the name. I use Bucky Doe for a lot of my examples, but all of the numbers, the credit card numbers, the types of debt, the process, the policy loans that we're creating, these actually do come from real customers. I've just changed names and some of the values to kind of protect the innocent, if you will. When we start talking about paying down debts, the first thing we want to do is get organized. I'm always amazed at how many people have debts, but they don't know how much they have in balances. They don't know what their interest rates are. So step one is let's go ahead and classify and identify what those debts are. Let's get that down on paper. For me, it's spreadsheets. But in this case, I had a client we worked with, and they had a number of different debts. There's like Chase credit card. They had a balance of $1,200 on that. It was a 0% introductory card, so they're making the minimum payments of $35 a month. They also had an American Express card with $3,500 of balance, and this one had a 27% interest rate. Their minimum payment on that was $113, but they were overpaying it and putting about $400 a month into that card. They had some unfortunate situations happen in the previous months, and they racked up some medical bills. Now, the medical payment did not have an interest rate on it. It was just a flat rate that they had to pay for, a certain amount of time until that debt was gone. And then they had taken out a personal loan. They have $12,000 at 7% on that. They had another credit card that was, getting maxed out around $12,000. And this one was carrying a 29, almost a 30% interest rate on it. And then everybody needs transportation. So they have a truck and making payments on that from the dealership. And then this particular person also had some student loans they're trying to get paid off as well. So when we look at this person's debt profile, they've got almost $100,000 of debt of remaining balance. They're actually making their payments are about $2,166 every month. Now, what we're teaching is how can we prevent that $2,166 every month just going out the door for the rest of this debt pay down cycle? Because at the end of the day, there's this concept called an opportunity cost. Think about it. Every time you have a dollar in your hand, whether you're using it to pay a truck loan, whether you are making it a payment to your Amex card, once that's left your hand, you have no opportunity to ever make money with it again. And it's not going to serve your family at all. It's not going to go into the war chest. It's not going to build legacy. It'll do none of those things that Jason talks about and teaches on the Founding Fathers webinars. So what we're going to be talking about is how can we change that dynamic? Now, when we start talking about debt pay down, there's a lot of different things you can look at. You may have heard of the snowball, Dave Ramsey, he teaches the baby steps. So he does help people pay down debts. but he takes them so far. I kind of look at it as you almost get out of maybe junior high or maybe even high school, but then you need to say thanks, Dave, and move on and find some more advanced strategies. But essentially, there's a snowball methodology to paying down debts. And what that means is you're simply taking the lowest balance debt, you're paying that off first. So all available resources, if you have extra money, if bonuses come in, maybe you had some extra cash that month, all of that goes towards that lowest balance. When that debt's paid off, you don't just take the money that you were paying and go below it. You add that on to the second debt and you just keep going after debt after debt after debt. You will accelerate your debt payment faster. Now, there's other ways of doing it. Some people look at it highest balance to lowest. There's another one out there, which we can talk about, called the cash flow index. And essentially what they're looking at is the efficiency of your debt. And they're looking at that by the remaining balance versus the payment. And they create an efficiency score and say, go after the lowest efficient debt first. And then there's the avalanche. The avalanche is looking at the interest rates on the debt, and it basically orders them in the highest interest rate to the lowest interest rate. Now, you can pick any one of those. It's going to be better than doing nothing. But if you picked one of those and you added the infinite banking concept, it really becomes powerful. And I'm going to show you the numbers. I'm going to show you the methodology. I'm going to show you how that works with a real use case. So let's talk about the options for paying down debts. When we have more or less three that I'm going to discuss today. One is what I call keep doing what you've always done. So when we look at these debts, we have a Chase credit card, we have an American Express credit card, we have a medical debt. So all of those debts, we can pay those off one by one and then just take the money that we were paying on those debts and go below it or add it into our budget, or maybe we start buying fancier clothes or we go out to eat more often. So as an example, let's say that my medical bill got paid off before anything else, and I had that $239.87. Well, instead of using that to pay on extra debts, I'm going to add that into maybe a new subscription, or maybe I join a gym or whatever it's going to be, but it's no longer going debt servicing. That's what I mean by keep doing what you're doing. Now, if this client, Bucky Doe, continued paying debts off as most people do, can you believe it's going to take 28 years to pay off almost $100,000 of his debt? Of that $99,779 of debt, the total payments that Bucky Doe and his family would have made would be $164,000, because $65,000 of that is interest that gets added on to the mix. So you might look at this and go, it's dire. A lot of people take the approach, I'm never getting out of debt. So, it's kind of just forget about it. We'll just keep racking up debt until we can't. So that's one option. Not that I would recommend that, but that's one option. The second one is I wanted to look at what would the debt situation be if you use the snowball, where we're structuring the debts to the lowest balance to the highest balance. And then as each one was paid off, we'll take that remaining payment and add it to the next. So just for example, the Chase credit card, we're paying $35 a month. And we want to get that paid off before the 0% introductory period. So we'll structure those debts appropriately. But when that $35 is no longer being used to pay to Chase, we're going to add that to the $400 on the Amex card and pay $435 to American Express. And by just continuing in that cycle, you will now have all of those debts paid off in 57 months. So that's a lot better than 30 some years or close to 30 years. And if you look at the numbers here, our total payments are down to $121, which means our interest, instead of paying $65,000 of interest, we're now paying $21,000 of interest. So for everyone watching this, I'm sure if this was you and you're looking at this as your debt situation, wouldn't you want to do it this way? It's a lot faster. It's a lot more efficient. I pay less interest. So essentially, from option one to option two, you're saving about 23 years of time and about $43,000 of interest. So that's pretty remarkable. And as we look at the different strategies, the highest to lowest, the avalanche, I mean, we're kind of bouncing around a few $1,000s difference, but is a couple $1,000s here and there meaningful to you? To most people, it is. So that's why we're trying to figure out what is the most efficient strategy. So when we start looking at paying the debts from highest balance to lowest balance, it does add a little bit more interest to the picture, but it's still pretty efficient compared to just paying them as we have always paid them. So 57 months, you're done. You've paid $21,000 of interest. And then the third, which is actually the most efficient for this particular client, is to structure those debts where we're looking at the highest interest rate to the lowest. Now, remember, we were talking about those introductory periods. We always want to consider that because if that chase card is going to go to a 30% in 2 months, I might structure those debts so that that's the first one that gets paid off, just to prevent that cliff from happening where we go from a $35 payment to 200, let's say. However, with all of that said, the avalanche, which is the highest interest rate to the lowest, is the most efficient. And again, we're saving a couple $1,000s based on the different options. So now we're paying about $20,000 in interest versus 21 or 22. And we've carved off another month, so we're now done paying all these debts in 56 months. How do you get engaged in this process? So let's say that you're watching this, like, hey, Craig, this sounds really great. I would love to learn more about my situation. Well, this is where if you work with Jason, the founding fathers, what Jason will help you do is go through a strategy session. In this strategy session, we want to know, what is your cash flow? What are your assets? What does your debt look like? Where does your money go? And when we had this conversation with the client I'm calling Bucky Doe, what I learned and what Bucky shared with me is he makes around $150,000 a year, and he was contributing around 8% of his paycheck to his company's 401k. Through watching different videos about infinite banking, being around our campfire, he thought, well, what if I were to change my contributions just to 3%? That way he gets his company match, and he's going to take the rest of that and start just adding it to his take-home pay and use that for this debt blaster process. So right there, he was able to pick up about $493.75 into his take-home pay. After taxes, I believe that number was. So that's now money that he has to use for the process. The other thing we'll talk with others about that are in debt is, do you have any mechanisms? Do you have any methods where you can, maybe pick up a side hustle? Do you have somewhere where you can pick up a few $100s here and there every month? And this client had a brother who had a bowling alley, and he decided to pick up some hours there on the weekend, just helping run the operations, do whatever needs to be done. And he figured he could make about $375 a month extra from his efforts there. So now he's got the 493, plus he's got the 375. And then Bucky also shared that he had been consistently putting $300 away into his community bank account. And that was really driven from his wife, who just felt that they really need to be setting some money aside for an emergency or rainy day. You just never know when something bad's going to happen. So that was kind of building up their emergency fund. They're trying to get somewhere the 3 to 6 month mark. So when you total all this up, their family had a little over $1,000 available that we could use for this particular project. And what their family decided is they wanted to use about $833 a month to put into the system. Now, when we say put into the system, Chris Noggle talks about the 6 laws of wealth. The first law is to pay yourself first. And this is one of the problems. When we go back to that slide that I showed in the savings, the American savings rate is under 5%, which is dismal. So the first law of wealth is pay yourself first. And it may sound contrary to, why would I want to pay myself first when I have all of this debt? It's not an and, it's not an or, it's an and. You can pay yourself first and pay down your debt. And that's what I'm going to show you next. So I just want to walk through this process. This is similar to what you can learn in a strategy call, just understanding your cash flow, listing out your debts, just kind of thinking through how can you maybe move some puzzle pieces around to build some extra cash flow, or reallocate where some funds are going so that you can make some progress on your debts. In this process, one of the things that we're going to do is design a policy for you. Now, when we talk about building your own infinite banking concept process, being your own banker, the tool behind the scenes that we use for this process is a specially designed whole life policy from a company that pays dividends and is mutually owned. And all of those things are important for a reason, because we want to have guarantees. We want to have those dividends. We want to have that as part of our system. I'm not going to go into great detail on designs. There are some different videos out there we can always point you towards. But the point I want to leave with you is we will sit down with you. We will think about your specific situation. How much can you put in a system? How can we orchestrate this to work within your debts? But essentially what we're going to do is, this is what we call a cash value analysis. And it shows you year by year by year how much you're funding the system, how much you have available to use. So if we were putting in $10,000, we would have available to use about 90% of this 6,826. What are we going to do with that money? We're going to take that and throw it at the debts. We're going to use this to accelerate your debt paydowns. Now you might say, well, why wouldn't I just take that 10,000 and throw it at the debts instead of putting it in this thing, and I only have 6,826 to use? Last week, Jason went over a teaching on uninterrupted compound interest. And the idea is, if you have $10,000 in a savings account and you take it out and you spend it, one, you no longer have the compounding. Number two, that money's gone from your family forever. So what we're talking about is just changing one thing and putting the money into this specially designed whole life policy for your own banking system, so that it will compound uninterrupted for the rest of your life while you're leveraging it and paying down your debts faster. There's no other tool out there. And you'll hear Brent Kessler talk about all the time. He's been doing this for, I think since 2006. I've been personally doing it for the last 15 years. If you can find a tool that works better than this, we want to know about it. So that's why we do spend a little time going through the design process and how to get you a policy that works for your specific situation. Now, what I want to show you is the process of how the money flows. So over here on the right, we've got all your debts listed. And remember, your actual payments are $2,166.14. We still need to do that. Now, in this case, you might go down to the minimums. That's up for discussion in the strategy session. This client decided to keep paying that $2,166. So out of the income, out of your paycheck, whether it's W-2, 1099, it doesn't matter, whatever your income is, you're going to continue writing those checks or making those payments to Chase, to Amex, to your medical provider, to the personal loan, the Wells Fargo, the truck, the student loan. That's going to continue to happen. You're going to be putting that money into those third-party debts. At the same time, we're going to honor the first law of wealth, which is paying ourselves first. And from the money that Bucky was able to save from putting in the 401k, that 401k reduction, plus picking up some extra money from the side hustle, working into his brother's bowling alley. And the third thing is just taking some of that money that they were putting in their community savings bank, adding that together. They're now making deposits into their own banking system, their specially designed whole life policy that pays dividends from a mutually owned company, because every dollar they put in this thing is going to compound for the rest of Bucky's life. He's not going to be able to stop that. This is going to continue on and on. But what's going to happen is, whether monthly or quarterly, we have an implementation team that will help kind of wire this up for you. But think of it this way. If I took out the maximum loan from that banking system, my own banking system, every quarter, and I threw it at the debt that I'm focusing on. So if I still have this Chase card, that's at the top of the list, I'll pay that off first. And we're just going to keep that cycle going. Income goes in to the debts, income goes into the policy, the maximum loans comes out of the policy and goes into the debt. We're going to do that until all those third-party debts are completely paid off. Now, think of it this way. You've taken all of those third-party debts and you've moved them into the policy. And why would you want to do that? If you can now move those debts into the policy, you're no longer writing checks or sending money to American Express or to the personal loan or to Wells Fargo. You're making a check to the bank of you. So whatever your name is, I see Linus, you're on. It's the Bank of Linus, the Bank of Dari. This money is going to your system. There's a very small percentage of it that is going to the insurance company in an interest charge, but it is minuscule compared to what you're going to be saving here. The next thing we're going to talk about is just reviewing the methodologies. So whether it's the snowball, the avalanche, the cash flow index, everybody's situation is different. And that's one of the things that this tool will help analyze is what is the most efficient pay down structure. So in this case, using the avalanche, we're going to pay all those debts off in 56 months. We're going to make about $20,000 of interest charges. But let's look at this. What happens when we use this and the infinite banking concept process? Using the infinite banking concept process, we're running that $833 into our own system and taking the maximum loans and throwing at those debts. We've now paid off all third-party debts in 42 months as opposed to this 56 months. Okay, so we've accelerated paying those third-party creditors off. So we've done that in 3.5 years. We teach all the time, we want to be an honest banker. So you have a banking system. We're not going to go in and rob our own bank. If you had a grocery store, you're not going to go in and steal your own food. So what we're going to do for the next 13 months is that $2,166 that you are paying to those third-party debts, that's just going to simply be a check written to your bank, and that's going to go into your system. So by the time it takes you to pay off all third-party debts, plus the time it takes to restore your policy loan, you will have spent 55 months completing this process. Now, let me go back and remind you that option one was to just pay all the debts off as everyone pays them off just one by one, and then they use the money and blow it. And then we talked about whether you use the snowball, the avalanche, the cash flow index, we can accelerate those debts. But there's two things that I want to point out, or one major thing I want to point out about those two options. When you're done paying those debts off in option one and option two, all your debts are gone, and so is all of your money. When you start using the infinite banking concept, we're going to pay those debts off in 55 months. But what I want to point your attention to is look at this cash value number. That's $38,521. That's how much cash value is in your system when you're done paying your debts off. So if you remember, we had almost $100,000 of debt to pay off. We paid that off, but we kept almost 40% of that. So that's something to consider. Is this something you would want to do? Give every dollar away, or at least keep 40% of it? There's something we don't talk a lot about, but it does come along for the ride, and that's the death benefit. So let's say during this debt pay down process, God forbid something happens to Bucky Doe, gets hit by a car, passes away, whatever it is. No worries financially, because his family will have this death benefit of $446,000 to help pay down those debts and help cover some of the costs that they would have in income lost. So when you look at the whole picture, you've got the death benefit coming along for the ride. You've retained some cash value. Not every dollar was lost. And so that's the real benefit of using this process. So we call this the winner. This is the congratulations. This is the winning bid here as far as the one with the most benefits. So what I want to show you is what does it look like once all those third-party debts are paid off. And it's just to reiterate, you're no longer taking that $2,166 and paying debts off because they're gone. What you're going to do is you're going to run that $2,166 back in as a policy loan. There's a few things that happen when you're doing this. Just think of a little portion of that $2,166 as being left with the insurance company for the use of that money, but it's very small, and we can actually show you that mathematically. Most of that, and that's that $38,000 that's going to be going back into your system. So if you do the math and you said, well, in 13 months of 2166. Let's just see what it is. 2166 times 13. It's about 28,000. So you put 28,000 in, but if you remember, I said you had 38,000. Where's that difference coming from? It's coming from the fact that your full amount was in there compounding the whole time while you're using this money. So that's pretty magical. So at the end of this process, when you've restored that policy loan in full, what do you have left in the system now? Well, you're done with your debts in 42 months. You're done paying those policy loans in 13 months. You have $99,000 of debt gone. Your family is no longer burdened with that. But here's where it starts getting really exciting. You have $2,166 of cash flow that was going to debt servicing. My question to you is, what are you going to do with that now? And that's where I would suggest getting back on a call with Jason, strategize. Maybe it's time to start another policy, maybe one for your spouse, your kids, and keep building your system. Maybe it's time to buy a new car and you can run the money through a system to buy a car. So that gets really exciting, or you can start using it for wealth building. In conjunction with this 38,521 you have in cash, could you use that for investing in something you know, like, and understand? A lot of the people in our community use the money from the policy for, say, private lending, where you can loan, say, 30,000 out to a real estate investor who might be doing a fix and flip, or they might be building rentals. They just need some short-term money, and they'll pay anywhere from 12 to 15% annualized for the use of that money. So whatever you do with that money, it's just something that benefits your family. And while you're using it, don't forget the whole amount is in there compounding and growing month over month, day over day. It gets better and better every day. So that's what your picture looks like if you were to use the Debt Blaster tool in conjunction with the infinite banking concept process. This is what it looks like for you. Now, just to wrap up, here's what happens. If you go through a strategy call and kind of share your debt profile, your cash flow, one of the things we'll do if you choose to work with our team is we'll build you a Debt Blaster report. That Debt Blaster report is going to show you your debts in the order that is the most efficient way to pay them off. So you'll see here we're using the highest interest rate down. It'll also give you an indication of how many months it'll take to pay off each one of these debts. And then it just breaks it down, option 1, 2, and 3. It makes it really simple. Which one do you want to do? Option 1 is showing you if you don't do anything differently and you just keep paying those debts off one by one, it will take you 336 months to pay them off, and you'll pay $65,000 of interest. And at the end of that process, all your money's gone. Option 2 is going to be take you 56 months to pay all those debts off, and you'll pay about $20,000 in interest. Now, I'm going to say that's a far better option than option 1. So I don't know why anyone would do option 1. Option 2 is where most people should be looking. However, just take one more step, and we'll take that sequential debt pay down that we're showing in option 2, and we'll just combine it with infinite banking. And again, just to reiterate, you'll have all of those debts paid off in about the same time it takes to do option 2. So 55 months, you're done paying all those third-party debts. You're done paying the policy loan back, which is your banking system. You have $38,521 of cash value to use again, to build wealth, to use for major purchases, to buy your next car, to do home improvements, whatever it might be. And you have $446,000 of death benefit at that time as protection, income protection for your family. So with all of that said, if you're interested in having this done for your specific situation, just reach out to Jason. While you're watching this on YouTube, don't forget to smash the subscribe button. We always appreciate that. But with that, that's what I have to offer you today. If there's any questions on the presentation for those here live, just go ahead and put them in the Q&A. I'm happy to answer them. Or if there's any comments, happy to address those as well. But I appreciate your time and look forward to helping you blast away your debt. All right, community, appreciate your time and hope this was useful. Just let us know if you have any questions on that, but I'm going to go ahead and call it a wrap if there's no questions. Have a great rest of your day.